Welcome to a special midday episode of Crypto Macro Insights. I'm Maya, and it's Thursday, September 4th, 2025, 2 p.m. Eastern. Tom, we're now in the final 24 hours before tomorrow's critical non-farm payrolls data, and the latest Federal Reserve data is absolutely extraordinary. The overnight reverse repo facility has collapsed to just $17.92 billion as of yesterday's close, that's down from $21.07 billion just 2 days ago. Tom, we're witnessing a 86.7% collapse over 6 months, from $135.26 billion in March. With Bitcoin holding steady at $111,751 despite this red September narrative dominating social media, are we positioned for the most significant liquidity-driven move in crypto history?
Maya, what we're witnessing is unprecedented in Federal Reserve history. A $117 billion drain from reverse repos in 6 months represents the most rapid liquidity injection we've ever documented. But here's the critical insight. That $17.92 billion figure yesterday, down from $21.07 billion just 48 hours earlier, shows this process is actually accelerating. We're seeing $1.5 to $2 billion leaving the facility daily now. At this pace, we could hit single digits within 2 weeks. That's over $300 billion that has been forcibly ejected into the broader financial system since March, Maya. This isn't normal monetary policy. This is a liquidity tsunami in slow motion, and Bitcoin at 111,751 is absorbing institutional flows ahead of what everyone knows will be a Fed accommodation cycle.
Speaking of the Fed accommodation cycle, tomorrow's non-farm payrolls consensus is 160,000 jobs versus last month's 209,000. But given the ADP report showed 104,000 jobs in July, which was actually a recovery from June's negative 23,000, how are you positioning for tomorrow's data? And more importantly, what does this liquidity overhang mean for Bitcoin's reaction regardless of the specific employment number?
Maya, here's my thesis. With $300+ billion in liquidity already sloshing around the system, Bitcoin's reaction tomorrow is less about the specific NFP number and more about narrative confirmation for continued Fed accommodation. If we get a weak number, say below 140,000, it confirms the labor market is softening and justifies the September 17th rate cut that markets are already pricing at 75% probability. Bitcoin could spike to 115,000 to 118,000 within hours as the Fed pivot narrative gets locked in stone. But even if we get a strong number, say 200,000 plus, the liquidity overhang is so massive that any Bitcoin dip below 108,000 would get bought aggressively by institutions who understand this macro setup. The key insight is that this reverse repo collapse has front-loaded the liquidity effects. The Fed is essentially pushing on a string at this point.
What's fascinating is this extreme sentiment divergence we keep discussing. Even with Bitcoin holding at 111,751 and this massive liquidity injection happening in real time, social media remains genuinely pessimistic. The red September narrative has people expecting crashes, rotating into gold mining stocks, predicting economic catastrophe. Tom, is this the most extreme contrarian setup you've witnessed in your macro trading career?
Maya, in 15 years of macro trading, I've never seen such extreme divergence between fundamentals and sentiment. We have retail genuinely convinced that September will be catastrophic while institutions are quietly accumulating ahead of the most accommodative Fed policy shift since 2020. The reverse repo data proves this. Institutions aren't parking money with the Fed anymore. They're deploying it into risk assets. Bitcoin's resilience at 111,751 despite maximum seasonal pessimism tells the entire story. Every retail seller between 108,000 and 112,000 is essentially providing shares to institutions who understand that $300 billion in forced liquidity has to flow somewhere. This sentiment divergence actually creates the perfect entry conditions for institutional flows because retail capitulation provides unlimited selling pressure to absorb.
Given this setup heading into NFP, what's your current position framework? Are you maintaining the conservative 3 to 5% allocation we discussed, or does this liquidity data justify more aggressive positioning?
Maya, I'm maintaining the 3 to 5% core allocation with stops at $108,000, but I'm adding a tactical overlay based on tomorrow's NFP reaction. Here's my framework. If NFP comes in weak, below 140,000, and Bitcoin breaks above 113,000, I'm adding 2% allocation with a stop at 111,000. If NFP comes in strong, but Bitcoin holds above 110,000, it confirms the liquidity thesis is stronger than economic data, and I'd consider the same 2% add. The key insight is that we're now in the final phase of this reverse repo collapse, at 17.92 billion and falling 1.5 to 2 billion daily. We could hit zero within 2 weeks. This isn't a time for maximum aggression, but it's also not a time to be underweight the asset that's absorbing the majority of these institutional flows.
From a technical perspective, Bitcoin has been remarkably stable around 111,751 despite all the macro volatility. What are the key technical levels you're watching for tomorrow's NFP reaction?
Maya, Bitcoin stability at 111,751 is actually the most bullish signal we could ask for. In normal markets, this kind of macro uncertainty would create massive volatility. The fact that we're holding this level suggests institutional accumulation is providing a floor. Key levels for tomorrow: 113,000 is immediate resistance. A break above on strong institutional flows could target 115,000 to 118,000 quickly. 110,000 is critical support. A hold above here regardless of NFP outcome confirms the liquidity thesis. Below 108,000 would suggest the thesis is compromised and we'd reassess. But honestly, Maya, with reverse repos at 17.92 billion and falling, I'm more focused on flow dynamics than chart patterns. This is becoming a pure liquidity play where technical analysis becomes secondary to Federal Reserve balance sheet mechanics.
Looking beyond tomorrow's NFP to the September 17th FOMC meeting, how do you think the Fed navigates this liquidity situation they've essentially created? Powell must be aware that this reverse repo collapse is injecting massive liquidity into markets ahead of their policy decision.
Maya, this is the Fed's biggest communication challenge since 2008. They can't acknowledge that the reverse repo collapse is essentially doing their easing for them, because it would undermine their credibility around data-dependent policy. But Powell absolutely knows that $300 billion in liquidity injection has already occurred. This actually gives them cover to be more hawkish in their language while still cutting rates. They can argue they're normalizing policy while the reverse repo mechanics provide the actual accommodation. It's brilliant Fed politics, honestly. They get to appear measured while unleashing the biggest liquidity injection in modern history. The market gets the accommodation it needs, the Fed maintains credibility, and Bitcoin absorbs the flows. Everyone wins except retail, who's completely missing the setup.
As we head into these final 24 hours before NFP, what should our listeners be watching most closely? Beyond the employment number itself, are there any other indicators that could confirm or contradict this liquidity thesis?
First, watch the reverse repo facility. If we see another $1.5 to $2 billion decline tonight, we'll be approaching $16 billion, which would be the lowest level since the facility's inception. Second, watch Bitcoin's overnight action. Any move above 112,500 or below 110,500 ahead of the data would signal institutional positioning changes. Third, watch Treasury yields. If the 10-year starts moving significantly higher or lower, it's pricing in NFP outcomes early. Fourth, watch currency markets. Any significant dollar strength or weakness affects the global liquidity picture. Most importantly, watch for any Federal Reserve communications. If any Fed officials speak today, their tone around accommodation could override tomorrow's employment data completely. The key insight is that we're now in the final phase of a 6-month liquidity injection that dwarfs most QE programs in history.
Exceptional analysis as always, Tom. To summarize for our listeners, we're in the final 24 hours before critical NFP data with the reverse repo facility at historic lows of $17.92 billion. An 86.7% collapse since March, representing over $300 billion in forced liquidity injection. This process is accelerating with $1.5 to $2 billion leaving daily. Bitcoin holds remarkably stable at $111,751 despite maximum red September pessimism, confirming institutional accumulation ahead of Fed accommodation. Tomorrow's NFP consensus is 160,000 jobs. Weak data confirms the Fed pivot narrative and could drive Bitcoin to 115,000 to 118,000, while strong data gets bought on the liquidity overhang thesis. Position framework remains 3 to 5% core allocation with stops at 108,000, potential 2% tactical add based on NFP reaction. Key technical levels: 113,000 resistance, 110,000 critical support. This is pure liquidity dynamics overriding traditional analysis. We're witnessing the final phase of the biggest peacetime liquidity injection in modern Fed history. Retail sentiment remains at historic pessimistic extremes while institutions quietly accumulate. The 24-hour countdown to what could be the catalyst for crypto's next major move begins now. Stay disciplined, watch the flows, and prepare for what may be remembered as the moment this historic liquidity thesis either confirmed or failed. We'll be back immediately after NFP tomorrow for real-time analysis of this potentially market-defining moment.